Welcome back to Wisdom University, where we unravel the mysteries of the financial world. If you haven't subscribed yet, hit that button now so you won't miss our enlightening content. Today, we're going to explore something called money market funds. Imagine a treasure chest, but instead of gold and jewels, it's filled with easily accessible cash-equivalent assets. That's essentially what a money market fund is. It's a type of mutual fund, a pool of funds from various investors designed to be a safe harbor for your money. These funds invest primarily in high-quality, short-term debt securities and pay dividends that generally reflect short-term interest rates. They're often used by investors as a place to park their money temporarily, especially during volatile market conditions. Now that you have a basic understanding of what money market funds are, we delve deeper into the specifics and how they actually work. So you might be wondering, how do these money market funds work? Let's get into it. First, it's important to understand that money market funds are a type of mutual fund. But instead of investing in stocks or bonds, these funds focus on high-quality, short-term debt. This debt comes from a variety of sources. It could be from governments, banks, and corporations. The key here is that these debts are considered to be low risk. They're often referred to as safe haven investments. Now you might ask, why short-term debt? The reason is quite simple. Short-term debts are less susceptible to interest rate fluctuations. This is because their maturity period is short, typically less than 1 year. This makes them less volatile and thus safer investments compared to long-term debts. But what does it mean for these funds to be high quality? High quality refers to the creditworthiness of the debt issuer. In other words, these are entities that have a high likelihood of paying back their debt. This further reduces the risk associated with the investment. Money market funds are designed to maintain a stable value. They aim to keep their net asset value, or NAV, at $1 per share. This doesn't mean you're going to get wealthy from investing in money market funds, but it does provide a degree of predictability and stability. It's a way to park your money, knowing it's relatively safe while also earning a modest income. This brings us to the income aspect. Where does it come from? The income generated by money market funds comes from the interest paid on the debt securities they hold. This income is then passed on to the fund's shareholders as dividends. Again, don't expect to strike it rich with these dividends. They're modest, reflecting the low-risk nature of the investments. One of the key benefits of money market funds is their liquidity. They're easy to buy into and easy to get out of. This is because the short-term nature of the investments means they can be quickly converted to cash. This makes money market funds an attractive option for investors who want a place to park their cash while maintaining easy access to it. In summary, money market funds work by pooling investors' money and using it to buy a diverse range of high-quality, short-term debts. These funds aim to maintain a stable value while providing liquidity and a modest income. They're a low-risk option for investors looking for a safe place to park their cash. To sum it up, money market funds work by investing in low-risk, short-term debts, which provides a safe and liquid investment option. Now that we know how they work, let's explore the benefits of investing in money market funds. These types of funds come with a plethora of advantages that make them an attractive option for a variety of investors. One of the most significant benefits is their low risk. Money market funds are considered a safe harbor in the financial world, as they invest in high-quality, short-term debt securities, reducing the risk of loss. Another attractive feature is the preservation of capital. When you invest in a money market fund, your initial investment, also known as the principal, is typically safe. This is because these funds strive to maintain a stable net asset value, usually $1 per share, ensuring that your initial investment is preserved. Let's not forget about liquidity. When you need your money back, you want it fast. Money market funds are highly liquid, meaning you can buy or sell shares at any time without any penalties or fees. This makes them an ideal choice for investors who may need to access their money quickly. Furthermore, While the returns may not be as high as other types of investments, money market funds do provide a modest but steady income. They generate this income through the interest earned on the fund's investments. This can be particularly beneficial for those who are looking for a stable income stream, such as retirees. But the benefits don't stop there. Money market funds also serve as an excellent option for parking cash in volatile markets. When the financial markets are in turmoil, these funds can provide a safe haven for your money while still earning a modest return. In addition to these benefits, money market funds are also user-friendly, with easy-to-understand terms and conditions, and are often accessible through a variety of platforms, including banks, brokerage firms, and online platforms. So, whether you're a conservative investor or just looking for a safe place to park your cash, money market funds offer a range of benefits. As with any investment, it's important to understand the potential risks and considerations of money market funds. First off, let's talk about the potential for low returns. Money market funds are known for their stability, but this stability comes at a cost. The returns are typically lower than what you might see with other types of investments. This is because money market funds invest in low-risk, short-term securities. While this ensures a high level of safety, it also means that the yield can be quite low. Now, moving on to inflation risk. The low returns of money market funds might not always keep pace with inflation. This means that the purchasing power of your investment could decrease over time. In a year with high inflation, the returns from your money market fund could be less than the inflation rate, causing a loss in real terms. Then, we have the unlikely but potential risk of breaking the buck. This occurs when the net asset value of a money market fund falls below $1, meaning that investors could lose some of their principal. It's important to note that this is rare, but it has happened before. While these risks are generally lower than other investments, they should still be considered. Money market funds are not insured by the Federal Deposit Insurance Corporation, FDIC, so it's possible to lose money. However, they are regulated by the Securities and Exchange Commission, SEC, which helps to ensure transparency and fairness. Also, remember that while money market funds are a good option for short-term savings or as a place to park your cash, they may not be the best choice for long-term growth. If you're investing for a long-term goal, like retirement, you might want to consider other options that could potentially give you a higher return. In conclusion, while money market funds are generally considered a safe place to invest, they are not without their risks. It's always a good idea to diversify your portfolio and not put all your eggs in one basket. Remember, while money market funds are generally safe, they aren't risk-free. Always consider your own financial situation and risk tolerance before investing. Let's recap the key points about money market funds. Money market funds serve as a crucial bridge in the financial landscape, providing a platform where individuals and organizations can invest in high-quality short-term debt securities. These funds aim to maintain a stable value, often pegged at $1 per share, creating a safe harbor for investors looking to preserve their wealth. The inner workings of these funds are fascinating. They pool together resources from various investors, which are then managed by financial experts who invest in a diversified portfolio of low-risk, high-liquidity instruments. This includes treasury bills, government securities, and commercial paper. The income generated from these investments is then distributed to the investors as dividends. One of the key benefits of money market funds is their low-risk profile. They offer a degree of security that is attractive to conservative investors. Moreover, their high liquidity means you can access your funds when you need them. And let's not forget the potential for modest returns, which, while not as high as some other investment options, can be a valuable addition to your overall portfolio. However, as with any financial endeavor, it's essential to keep in mind the potential risks. While money market funds are generally safe, they are not entirely risk-free. Market conditions can and do change, and there's always a possibility, albeit small, of losing money. It's also worth mentioning that inflation can erode the real value of your returns. As always, it's crucial to do your due diligence and consider your personal financial goals and risk tolerance before diving in. There you have it, a comprehensive look at money market funds. Thanks for tuning in to Wisdom University. Don't forget to subscribe for more financial insights. Until next time, stay financially savvy.